So a bit of an introduction for those of you who don't know me. I think everyone except Llama here. I'm Pigeon. I'm a leverage trader. I've been trading for a few years now, mostly crypto. I mostly keep an eye on stocks to know how that impacts the crypto market. But I'll mostly just be focusing on crypto for my posts within this Discord. I'm going to be doing these live chats like every week, and be posting some alerts for the Lendal community. Uh, Thought I'd start off with the most, I guess, important thing to know for a lot of people here is how to read my alerts that I'll be doing, because otherwise there's not much point in doing them. So let me pull one up here. This is one I did for a different group, and it's very basic structure. In that I'll generally just be posting a direction, a ticker, and then the entry. So in this case, I wanted to short BNB below 256. So that's $256 with the take profit targets of 240 and 220, and a stop loss at 273.5. But we don't want to immediately enter a trade just because it hits that entry. So I'll always post a requirement, if you will. So in this case, I was waiting for a relief bounce or a break and then a retest. So essentially, price comes through this level, breaks into entry, and then comes back up around that support level, and then we take our entry there. And that's a safer way of entering. But basically, there will always be like a note and a to follow, and that's kind of how I want to structure these plays and all that. I'll go a bit more into how to take these in the future as well, and later in this session. Right. Thought I'd chart high-term timeframes for Bitcoin and ETH here, and then kind of go over how I would look at these and where I see this going in the near and long term. Because long term, I'm very bullish on crypto. But short term, we might still have some falling to do, so I'll always go through my charts and see what's going on with them now. We're still very much in a strong downtrend, and the easiest way of seeing that is that we have this very clear line of resistance that we haven't even gotten close to breaking yet. You know, it's every time we come up to it, we just get rejected and rejected and rejected. And this would be like breaking this would be the first indication for me that we might be changing the tune on that. So back in a few months back, I was talking to some of the other groups about potential targets for this bear market. So this was back in March, and we've hit a lot of those. I basically have one more target that I've been looking for, and I drew this wrong. I have one more target that I've essentially been looking for as a very nice place to see a market bottom, and that would be around the 14.5k level. I'm essentially looking for a bit more downside here before likely finding a bottom. I don't think we go that much more lower. So I'm just expecting us to stay in this area for the medium term. My final support level, if you will, is our previous highs. Let me actually grab a different chart for this, or I've already drawn it out. Makes it a bit easier. So we're nearing that 14,500 level. But the last support, if you will, is in this like 12 to 14,000 area, where we had our like 2020 highs, like the mini bull run we had in 2019 and 2020. That's and where we had the breakout into the 21 bull run. That's kind of where I have my my you shall not pass level. ETH, on the other hand, is a bit different right now in that it's been holding really strong. So it has come down quite a lot here, but it's been holding on to this one trend line, and this is what I call base support. So this is the most relevant support resistance line I can find on this chart, if you will. And you'll find these on any chart with at least a decent price history will have a base support level, and these are very good levels to keep in mind because price will always move towards them over time. So you could think of it as a big rubber band, and as it moves away from that line, it'll start pulling it back towards it. So another good example of that is on the S&P, which has had a very long-term price history. Why is it doing that? That's not supposed to happen. It's moving my fucking line when I'm not moving it. Yeah, you can see it's always traded around this line, and I mean this goes back, if it doesn't move, goes back all the way to the last century, to the 1800s even. And you can see it always trades back to around that same level, and you'll see it does not. It doesn't hug it or anything, but it does always come back to that area. And that's why I think these are very important to keep in mind. That's also where I'm looking for a bottom on the S&P, is somewhere around this line, and we just trade back up, and then Fed prints more money, and we just go into to another fucking bull run, if you will. Yeah, going back into crypto, because that's my my strong suit. I think ETH is, while it is holding strong, I think it is relatively easy to say that if we do lose this level, it's goodbye for a while. We'll probably go back to triple-digit ETH. As to how far that'll go, honestly, not too sure, because ETH has grown massively in the last cycle. I mean, the previous one, it went from our high here at 1400 down 94% to 81. I don't think it's going to see that happening again. I mean, we're already down to the max was 81%. Seeing 700 ETH is definitely on the table. But here, my absolute low for ETH here would be around this 400 level, where we have some previous support and resistance area. As for the lower term timeframes, Bitcoin's been doing little to nothing, but that's kind of what I use as Bitcoin is the coin that I use for gauging what the entire market is doing, essentially. You can see I had loads of little levels drawn here. These are previous supports that we fell through. Just get rid of those now. But In essence, Bitcoin has been just ranging for the past month here. Wow. Not really doing much, and I'm not really too concerned about anything happening until we either get below 16,000 again or back above 18,500. Anything that happens in between there is just noise. While you can trade it on lower term timeframes, and I am trading, I'm not expecting any major moves to be happening as long as we're in this range. So that is again between essentially 16,000, let's just say 15,850 because that's these lows, and 18,500, something like that. Anything that happens in between here is just noise. But if we do get below these levels, very likely to see that 14.5 area, and maybe as low as I mentioned, the 12,000 to like 13.8 I got marked here. Those are like my lows for this cycle. And I was on this chart. As for if we do break above the 1815 level, you can essentially just take previous resistance lines and look for them as price targets, right? So if we do get a break of 18.5 here, we can very likely see a move back to the 21.5 area. Would I say the bull market, the bear market's over at that point? Probably not. Like until we start clearing these levels, I mean, I'd personally say like 23k is like my like if we start closing like a daily or weekly candles above 23k, that's kind of where I'm looking to, hey, maybe the bear market's done, or at least maybe we're done being in the depths of despair. You could see that on this chart as well. I mean, we left the depths of despair, but it kind of, like, it moved a lot, but it kind of still just did nothing for a while. So once it broke out there, it was a breakout a couple 100%, but yeah, it just traded sideways for another 500 days. So time-wise, I do not think the bear market's over, but price-wise, I think we're very close. If that makes sense. I've just been I've been using these orange lines, and maybe I should actually explain. This is a Fibonacci extension. It's one of the tools I use most for price targets on anything, whether it's on this like a weekly time frame or daily time frame. So for macro, you can use it. It's what I've been using for these targets. I mean, you can see 18,800. This was my target since we were up at 30,000, right? So, and you can see how well that held, and that's kind of how I look for like major price targets in markets, but also if I'm on very low time frames, you can do the exact same thing. So if I were to go, of course, there's no easy. Let's just do it here, right? If I said like that, it's very basic, but you can see how each of these levels hit one by one, and it kind of stops around these levels. This isn't perfect, obviously, but I just wanted to find something quickly. But you can see how these, they always tend to trade between these levels, even on low-term time frames, but also when you go to these very high-term time frames. And the way you use them is pretty simple in that if you expect price to go down, you take a fib from the high, like the swing high. So essentially the most eye-catching high in your chart. You take it to your swing low against eye-catching low, and then your next swing high. So in this case, it's very obvious. You got your all-time high, a low where it, pivoted and went up a bit, and then you got a high where we rejected and went back down, and that gives us these levels. There is one other type of Fibonacci that is popular, at least, that you'll see me using as well, and not to be confused with them, and that is the Fibonacci retracement. And rather than grabbing 3 points, you just grab 2. So in this case, I would grab, say, my high, then my low, and I'll get a whole bunch of levels that it also trades between, but these are a bit different, and you use them a bit differently. So it's called a Fibonacci retracement for a reason, because we use it to find where price might retrace to. So if I were to grab a big one from here, so that's my swing high and my low, each of these levels would be a level that price would come back to. So it's always retracing to the 1 fib. So I got my 1, I got my 0, so the first one I grab is my 1. And when price makes a violent move, we use these to find areas where we might want to maybe enter shorts again. Say we shorted around here because we thought it was going to go down. Well, maybe I wanted to short again around the 0.5 level. We get there, and that was a very lucrative level. Generally, you can see that this is marked out gold. This 618, and I got the 0.66. These are the most relevant levels. This is what we call the golden pocket, and price will almost always try to move to those to that level essentially. So I'll have a lot of strategies based around trading with the golden ratio, the golden pocket, whatever you want to call it, the 618 and the 0.66 fib. So you can see here, this is a nicer example. We had a downtrend, so I put my 1 fib, I pulled it my retracement from the top, from the swing high to the swing low. And you can see that the retrace, so the relief on the downtrend essentially, came exactly to that 618 Fibonacci level, and then came back down. So that's generally how I use these for finding potential reversal ends of relief rallies, essentially. If I'm making any sense with that. Yes, it is recorded, Plaza. If I'm just rambling on too much and I'm not making too much sense, please just stop me and just ask me. I'll clarify. But otherwise, I'll just continue rambling.
We love a good pigeon ramble, mate.
Fantastic. Glad to have you here, JT.
Couldn't miss this for the world.
Awesome, man. Yeah. The other way I use Fibonacci retracements, and this is one I'm a very big fan of. I will actually switch my setup here, and I can go into one of my strategy style things. So one of the ways I use this is, you'll notice that when I draw these, if I actually draw one, let me find a good example. So say, right here, let's just do that. So this time I drew it the other way around, with my 1 fib being at the bottom and my 0 fib being at the top. And this is because I'm looking for continuation in a trend. And essentially what I'm doing here is I still have my golden pocket, right, my 618 and my 0.66 fib, but I'm essentially looking for price to enter that region. So here it did. And then when it breaks this level, this 1 fib, I can almost always expect it. I mean, like 70-80% of the time, maybe. expect it to go to the 1272. So this is my the next level of the Fibonacci. You can see how perfectly these candles stopped right on top of that. And then oftentimes you'll even see continuation to the 1618. It's covered up a bit right now, but you can kind of see it's there in the gray. That is these are the two extension levels on the retracement, if that makes any sense. And this is how I take a lot of my profit targets, is by drawing a I guess inverted fib retracement. So rather than using it for finding where the actual retracement goes, I use it to find targets for continuation. And they've been very consistent for me. So what else? Right. Let's go there. Actually. Right. So another thing I wanted to go into, it's not that relevant, but it is very interesting. This chart I've pulled up right here, this is the S&P divided by the actual money supply in the US. So the US M2. So this is all forms of broad money, essentially. And when you look at this, it paints a very different picture than if you look at the regular S&P. So the regular S&P, it's up and to the right. It's up and to the right for the last 100 plus years, right? But when you open this, you'll realize that, wait a minute, this says that there's no real growth since 2000. And it's something I find very interesting, because you'll realize that since the dot-com bubble, and then the 2008 crash, it's all just been a lot of hot air filling the markets, because in a growing economy, you would be seeing the growth of the stock market outpacing the growth of their money supply. But that's not happening here. And you'll see that, we're basically nearing the COVID low here in terms of the actual value of the United States stock market. It's a similar thing to if you guys know what's been going on with FTX, how they bought their own currency and then used their own currency, said it was worth a bunch of money, and then tried to take out loans on them. That's kind of what's been happening in the U.S. economy and in most modern economies. Is they print their own money and then pretend like it's worth something, when really the value of their economy hasn't gone up in 2 decades now. Not very relevant, but I thought it was very interesting. Something a little more relevant is the Dixie. And even on currencies like the US dollar, that's what this is, you can apply charting principles. So in this case, I've got a single main trend line dating back to 1980 and 1985, when we had a massive collapse in the value of the dollar. And then we saw that same level hit we reached another high in coming out of the dot-com bubble. And I essentially drew a line from there, and you'll see that after we came back up here, and it was pretty much a straight line up. Price just went up like a rocket, and then it started facing some difficulties once it broke that. But then one very I guess, important principle to know in trading is when price goes up and then goes down, it's very easy to go back up again. And if you want to see, like, for a chart that's more likely to go down, if you will, it's pretty much always just going to go this. Like, it's going to start slowing down, and then it's going to top out and come back down. And essentially, that's like how you spot tops a lot of the time, is by looking for price action that is not like retracing at all. So when price just keeps going up, it's going to run out of juice, and it's just going to crash. Whereas if you stair step your way up, you keep going, and that's where that movement also comes from in these big runs. And that's why you see a bit of tangent, but when you go to like these high term time frames, lower term time frames, like even in the big fucking bull run in the most volatile asset in the world or whatever, you get these big, I mean, this 15% just in a few days, and these are just big pullbacks happening consistently throughout this move up. Now this is parabolic, but then you see it happen here for real, and then you get a topping pattern where every high is slightly higher, but you can see it's running out of juice. It's not really going anywhere. So when you look at that on a weekly, it'll be more clear in that it's not pulling back at all. It's just it's making that topping pattern, right? It's moving up, it's slowly topping out, and then it just dumps. Granted, we did come back in this case, so you could actually argue that we had our pullback here, but then again, we didn't do much after that, sadly. Yeah, again, going back to the Dixie, to the dollar, we finally saw a break of this this line happening in 2015. But you can see it took its time, but it basically moved sideways and down, which is generally bullish. You can see we had a big bounce come out of that, bit of a retracement, and now it's just been on a tear. It's just been going parabolic until just about early November. We started seeing a bit of a pullback, and actually this is going very aggressive. So this is where we might take our fibs, right? And we might say that, we just passed the 382, so we might fiddle around a bit here, or then move again to the 0.5, or we just slowly work our way down to the golden pocket again, and maybe continue from there. If I actually invert this, I would use it like my other charts. Basically the 618 and the 382 are inverse of each other, so you can kind of see that's it might just hold for a bit around here, but it looks like it wants to keep going down, and not fiddle around too much. And then you'll see this fib level lines up very nicely with these highs. Better way to do that is like that. And that would be a very nice place to see a bounce. But what does that actually fucking mean if we get a bounce? So whenever dollar goes up, people want dollars, they don't want assets, so they get dollars, and assets go down in value. Or just the dollar becomes worth more, so other assets are worth less in comparison. That's another way of thinking about it. But essentially, the way this is headed right now would be saying that until end of January, probably, this will continue down if it's just a straight line, right? Which would mean that until the end of January, we might have some relief in stocks and Bitcoin and all assets or whatever, which is, yay, Santa rally, right? End of December, get a big pump in assets. People always like the Santa rallies. I'm not of a particular mindset about that at all. I'm not particularly convinced, but I'm not going to say it's not going to happen. I'm going to say I don't know because, as I mentioned before, we're in kind of a nothing's really happening zone until we get below 15.8 and or above 18.5. Nothing's happening. So I'm not going to worry about it too much. Seeing a falling dollar is very interesting for a European like myself, though, in that I natively use euros, and I've basically been completely in dollars since June, July 2021. When I saw it hitting one of my trend lines is a bit messy, but I basically saw it forming a double top here, so it came up, it retraced, and then it failed to make a higher high. It got rejected again in that same area, and then it was making some shitty price action. I basically started taking all of my salary and shit in dollars, and I converted my euros to dollars, and I've essentially given myself for a while I gave myself 18% more buying power just from being in a different currency. Now it's about 10%, but I've swapped a bunch back to euros already. Again, fannying around here, right? Just if it does, wick back up and just do nothing for a bit, that would be in line with the euro here coming into some big resistance. In that, yeah, it's resistance. So I'm essentially either looking for this to continue up, and then you can see here end of January we see a pullback, and we might see some bullish continuation later, but I have to see about that. But that would basically mean Dixie continues down until end of January, and then we'll see from there, right? It'll probably have a bounce of some extent, but I don't know how far that's going to go. We'll have to, I guess, reevaluate at that point, and otherwise it's we might see a wake back up here and just see some bullshit action. Which in the euro, if Dixie continues down right now, again comes up, end of January comes back down, or if it just holds here or bounces from where it's at right now, we might see a rejection here and maybe see a retry later. We'll have to see how that goes. While the pullback on the Dixie is very large, it's a big pullback. I do not think this is done. I think most likely it is just gonna bounce in this area, probably chill for a while, but then be on its merry way again to maybe 122 or whatever. By the way, my this again with the trend-based fib extension. So if you want to get a bullish target, you grab it from a swing low to a swing high to a swing low, and my target has been for a while here. I drew this back in December. It's just been hitting target after target. I actually got this super close in that I said that in Q4 we would retrace from the 1618, so around 114.5. I was a week off and it wasn't quite Q4 yet, but yeah, it seems to have adhered to my plans. So it's been nice for my coin stack. Right, I had some stuff I want to share in the resources channel in this Discord. Pulled it up here as well. I posted a whole bunch of resources that I've compiled and that I've been using in crypto, and I recommend you all check it out. There's some very useful stuff in there. So there's the obvious stuff like TradingView. I mean, it's what I've been hosting this entire stream on. You know, it's the most common charting tool. But below that, I have Coinalyze, which is a different charting website, and it gives you further data that TradingView doesn't have. So, for example, I got a buy-sell volume. This isn't too interesting to me, but what you can do is click add extra data, and you can find open interest, you can find funding rate, liquidations for any asset on different exchanges as long as they have them. And there is the CVD. So this is the cumulative volume delta, and I'm not going to get into this right now, but you can essentially see where buying and selling is happening. So back when Luna was collapsing, I don't know if you guys were there for that, but you could see that there, essentially, there was no one buying anything in spot, but the only reason there was any bounces in price at all was because futures traders were bidding it up, and that's how that you can use that for a variety of things. I'm not going to get into that right now, but you can see that through tools like this. The main thing I do recommend it for, though, is I can't use that on this chart. The VRVP. It's this gray thing on the side here. It's an indicator I'm very fond of, and what it lets you do is essentially it shows you where the volume gets traded. God damn it, fucking dirty ass charts. I'm sorry. Where volume's traded on specific charts. So if I pulled this up, you can see that there's these very big spike zones, and there's ones where it's very small, and essentially these big spikes, this is where the volume is, right? This is where people are trading, and these big gaps are where there isn't much volume. And essentially what price tends to do is just completely ignore these gaps. So if it say gets up now, or in this case gets down, that's what it looks to be doing, right? Once you get to say like halfway through here, wrong one. So you get to that line on some volume. There is basically no one that's going to stop you. So it's not going to stop here, right? What it's most likely to do is come back down to this, where there's high volume, right? So it's just going to make these explosive moves, and the same thing here, right? You have there was no real trading here, so there's no volume. So you can see there was just two big candles, and that resulted in this big gap here. So now if you say get up above there, all of a sudden you're just nuking up, right? So you probably see something like that, and then boop, and then you're back in this zone with volume, right? You're back in a high volume area. And this can be very useful for, again, finding targets or knowing if your targets are too greedy or not, right? The exception to this is I did say like it wasn't going to stop here or whatever. Sometimes you do have, like, if I were to grab a fib retracement or whatever, right? In this case, the 618 is right in the middle there, as expected. Sometimes when you get like bullish price action, it does just ignore this, and it'll just essentially bounce from the middle there and up. I don't think that's going to happen right now, but that's not what I'm here. But one important thing to keep in mind, right, is while nothing is there to stop it once it gets going in these low volume zones, right, these low volume areas, it also means that there's no one that wants to push it into that area. if you will. So what you'll find is if I were to grab like the high, like where this starts really dropping off, so say there, that ends up being the high of our price, right? Where we've essentially been closing all the candles. That's our resistance. And the same thing will happen on the bottom side. That's our support, right? So once you break these levels, that's where you can get these big explosive moves down. But it also means that you'll find a lot of fake outs. So like you'll see a big wick on this candle, right? Because this was trying to break that that resistance into this low volume area, but people just sold it back down, right? The price came back, and that's an important thing to keep in mind. Is if you are using these volume gaps, is to always wait for your candles to confirm that that's actually what they're doing, and they're not just gonna come back to bite you. So closures are very important when using a VRVP. Yeah, that leads into this again. In the VRVP is a paid indicator, so you don't get it for free unless you have TradingView Premium. But websites like Coinalyze, they have charts, and if you don't want to spend money on your charting or whatever, and you still want to play around with it, you could just go to indicators here on Coinalyze and search VPVR, and it's right there. And then you can go in the settings, customize it. So I made everything gray here, all the areas, and then I increased row size to 150, so I can actually see the details. Yeah, that's a free way to get the VRVP. Some more of the things I got in here. I got the exchanges I recommend. So Bybit is the exchange I mostly use for my trading. It's what you basically always see me using when I'm leverage trading. Binance is what I have for more general like spot buying and stuff. Is generally what I do through Binance. Though the nice thing about Bybit is it doesn't require KYC, and it's available in most places. And because it's non-KYC, even if it's not available in your country, you can just use a VPN. I've got a few news sources here. My quick opinion on news is that it's not really that relevant, in that a chart will almost always show you what's happening in the news, unless it's a black swan event like we had in March 2020 with COVID shutting everything down, right? But that happens once in a blue moon. So I'll keep up with news, but I don't trade based on news, because I'll never have insider information on news, and unless I have insider information, I'm not going to be faster than whatever algo people have running for trading news. And I don't really know what the reaction is going to be, so at that point it's gambling for me. So I don't trade based on news, I just trade based on the chart, and the chart generally tells you what the news is going to be like. What I find more relevant is some of the data here. So this is a site I'm a big fan of. This has a lot of the data you might find throughout the ecosystem, I guess, in one place. You can find exchange flows, all your on-chain data for free, or well, not all of it, but a decent bit of data on like leverage and some on-chain stuff. Though right now, I mean, it's a bear market. I'm not too worried about that. The main thing I use this for is not the leverage ratio. Is it just on the main dashboard then? I don't know where this is. I forgot. Here, the global open interest. So back during the bull market, whenever leverage got way too high, it had to be flushed out essentially. So you'd see big retracements in price whenever this got too high. So I'd make sure not to get over leveraged going long when this, was over leveraged. Right now, I'm not too worried about it, but it's nice to keep an eye on some data if that's your thing. Yeah. The more relevant ones right now I've listed here are the macro events. So you got the Fed calendar and Trading Economics. This is a website I just use. They have basically all the data I could possibly want and when it comes out. So I clear this and just say, of course I don't know what the fuck. There we go. So in this case, just US. See that non-farm like jobs report is coming out early January, but there's not much else going to be in the rest of this year, which makes sense because it's the holidays. You can see previous month. So we had it'll tell you where the FOMC. So we had interest rates, we had inflation rates, et cetera, and it'll update in real time. So it's a nice way to keep track of that. And outside of those resources, I haven't posted these yet. I'll post them in a second as well. I wrote these for a different group, and it's essentially, I guess, rules, general crypto rules, or general trading rules that I always tell people to stick by, and then I try to stick to myself. Some are more important than others, but a very important one when actually trading is to never risk or lose more than 5% of your account on a single trade, because that just generally means you're over leveraged and you're risking too much. And once you start losing 5% on a trade, it becomes very hard to make that back, because making more than 5% in your account on the trade is unrealistic unless you're on very high time frames trying to catch major moves. So I generally just say don't risk more than 5% of your account on a single trade. I'd honestly say even less than that if you have a lot of money. Don't trade while you're emotional, because emotions are the enemies of traders. They fuck with your trades, and they ruin your plans, and it's not a good time. And leading into that as well is having a plan before entering a trade, and just sticking to it is a massive thing for me, at least, as well, and I know for friends of mine as well, because it helps with not being emotional, right? If you know how you're going to play this well before you even enter the trade, it makes it a lot easier to turn it into a successful trade. Because as a trader, I always say, yes, technical analysis is nice, but realistically, it's maybe 30% of trading is actually knowing that which direction price is most likely to go, and the other 70% is managing your emotions and managing risk. Because it doesn't matter if you know where price is going to go. Maybe I'm a fucking I know for a fact that it's going to go up. It doesn't matter if price starts, doing this, and all of a sudden I get scared and close my position only for it to then pump up, right? So it's managing your emotions and managing your risk that is way more important to becoming a successful trader. Another way, a good thing to do, I guess, is taking notes, right? Especially when you're learning how to trade, right? And I do this even now. What went wrong in a trade, what went right, things to keep in mind whenever you're trading. What do you notice in yourself when you're taking trades, or what do you know about notice about your strategy that could be improved on, right? And by taking notes on that, it's easier to improve on those aspects. This is also just resolved by having a plan, but don't chase green or red candles. Generally, it doesn't end well. I don't want to enter basically ever if I'm seeing this kind of stuff. Well, yes, it did have another big leg down, but for all I know, it just has another massive leg up, uh, and I just got my face bashed in. So just not chasing candles is another important thing to keep in mind, and I think just again having a plan, generally a trading plan or a strategy, uh, makes it a lot easier not to give in to FOMO. This is more for when you're actually making your strategies. Is don't fight the trend, right? Just by trading with the trend, you can increase the success rate of any strategy by 20%, maybe more. It's so much easier to trade with the trend than it is against it. Because again, the trend is your friend until it the trend is your friend until it bends. So like I can be in, I can get longs here, right? I could enter long positions out of this dump, and yes, it did indeed go up, right? So say you caught the perfect bottom here. That was a 43% if you got the perfect bottom to the perfect top, right? But you could have also just been shorting, right? And I mean, in the entire time, right? This was a minus 63% dump, and that's, relatively speaking, I mean, this dumb to do on a daily chart. It's kind of hard to explain, but when you're in an uptrend and you're longing, the gains are just better than if you're shorting in an uptrend. Essentially, your probabilities go up, your profits go up. All in all, it's just a good idea to trade with the trend. And in case you didn't realize, we're in a bear market, we're in a downtrend, so shorts are still generally the better choice until the trend bends. Again, I mean, I think everyone knows this now with the FTX blow up, but money on exchanges isn't yours. If you don't have your keys, it's not your crypto. So just keep your stack on a wallet. Like yes, I have trading capital on exchanges, but I keep 90% of my pot in cold wallets. I do not fucking interact with them on sketchy websites, and I just make sure people can't access them, and that way I don't get wiped out by a scammer or an exchange blowing up when we're already down like 80% from the high. I don't want to get fucking taken out at this part of the fucking bear market, right? So better safe than sorry, and just keep your money off exchanges. This is something I'll go into in a future stream, and that is backtesting strategies. So a lot of people find a new indicator or a new strategy and they just start trading with it. What I do is I go into a spreadsheet and I essentially see what the historical returns were for these strategies. So you'll see that here. All these lines represent a iteration of the strategy. Now there's a lot less because I deleted a bunch, but like I can say with statistic certainty what the returns of my strategy has been for like the past, say, last year in different market conditions. How can I adjust my strategy to do better in different markets, and that just basically means that you already know if it's going to be profitable or not before you start risking money on it. And you can, maybe it's not working anymore in your market, but maybe it worked in a different market condition. So say the market's been very flat over the last, month. So maybe like the strategy, one of my strategies just does not work in this market, but it works great back here when things were moving up and down a lot. But in sideways, very flat markets, it just doesn't work. So I get different strategies to use in different market conditions. And I know this from testing them without having to lose money on them, if that makes sense. This is not so much a commandment, but if you're playing a pattern or a breakout trade, this is the only real time when I bother looking at volume. And I mean, volume is basic on any chart, but whenever you're looking for a line to break, did I have anything on fucking Rips testing? I had one earlier, but if I want to be breaking, say, this support line here, no. So say I want to break through that like I did here. Well, what I'm going to do is I'm going to look on my volume bar. Is it actually increasing? And you can see volume was moving up, going into that resistance line, and that's generally a good sign that any break of that is an actual break. And it's the same for support, of course. And it's the same thing for patterns, whether it's your head and shoulders or whatever, right? If I zoom out here, we had a big head and shoulders on Bitcoin here. You can see I want to see my volume moving up into that resistance line, into that neckline, to confirm that trend or that break. Well, I guess in this case it was pretty obvious that it broke it, but that's just something to keep in mind if you're playing breakouts or like fucking pattern strategies. Another thing, I tend to stay off Twitter, or well, I tend to not listen to too much on Twitter or people I don't know, because that can affect your own view on the market, right? I know for a fact that I've been very successful in knowing where the market's going and letting other people influence your opinion when you don't know them and don't know them to be reputable. It's very easy to overlook, but it can definitely sway your view, which can lead to bad trades. Something very obvious, of course, don't trade with what you can't afford to lose. I personally know some people who traded with money that they couldn't afford to lose, and they're not so happy right now. Like people just trading with rent money, it's just something you don't do. Yeah, just if you're going to be trading at all, like it's risky business, even if you know what you're doing. Like even if you have a strategy that has a 90% win rate, there's still a chance that your shit goes tits up, or you make a mistake somewhere, or your money is on FTX and it blows up, and all of a sudden you can't pay rent. You know, that's not a situation you want to be in. It's a situation you never want to be in. So, while obvious, just don't do it. This is more something that you're going to see mostly in the crypto bull runs. But if something looks to be too good to be true, it most certainly is. So a while ago we had in crypto, it was called DeFi 2.0, and we had basically apps giving 70,000% APR, so annualized percentage returns, or whatever. I think that's what it is, anyways. So if I were to go to one of their charts now, so you'd get 80,000% a year essentially return on your whatever you put in. But what you don't realize is that when everyone's getting 80,000%, a coin can run up to 10,000, and all of a sudden you bought your coins at 10,000, but you're getting 80,000 per year. But within that same year, you go from 10,000 down to actually it was 3 months down 97%. Like, there's no return. Like, any yield like that is always too good to be true. It's not going to happen. I made a bit of money on this in that I was trading in and out of it, but at some point, it just kept going down, and there was no point. So I lost most of what I made pretty soon after. So I got out with a very small profit that it wasn't even worth my time. I might as well have gone fucking working a real job at that point with the time I spent. But it is what it is. And then some more obvious stuff. When sending crypto, just double check the address. I know people who've sent things to the wrong address, and then all of a sudden they're wondering whether crypto doesn't arrive, and then no one can help you because it's nowhere. A slightly more important one is don't overtrade. Wait for actual setups. I know this is something I've done a lot myself. Is take trades when there aren't really any. Like, oh, I think the next little bit is gonna go down or whatever. You go on the fucking 15-minute chart and you're like, oh, I think that it's gonna go up here, and then it's gonna go from there. It's gonna go down to here, and then you're actually trading that. I would much rather, if I think it's gonna make a move like this, not even bother going long. I just get a short there and take it down to maybe these lows or whatever, right? I'm not looking to play multiple directions in and out every time. Like, scalping like that, I leave that to the robots, because realistically, you're gonna be wrong. Even if you get it correct a lot of the time, it's just not that worth it compared to just grabbing a short right here and taking it all the way down there. Whereas if you're sitting here over trading, you might think, oh, well, I think it's going to bounce. I'm going to get a long right here, and then you might be right, and then I'm going to get a short right here, and you might be right, and then you say, oh, I'm going to get a long right here, and then you get nuked. Just don't do it. It's really just a waste of time. Again, just getting a proper strategy generally prevents this anyway. And then my last point, if something is retarded, don't fucking do it. I've done it a decent few times myself where I know something is stupid, but I'm like, yeah, let's do it anyway. Like, risking more than too much of my account on a single trade. It just doesn't end well. So generally, when you know something's stupid, in the back of your mind, just listen to it. Just don't do it. Oh, JT's gone now, but he asked, do I have a time of day I typically trade? No, I just trade whenever I feel like trading, or whenever there's a trade that I feel is worth taking. Anything else? I think I pretty much went over all the things I wanted to pretty much cover. I mean, if there's any questions or anything regarding what I said, or things I haven't said that you guys were wondering about, by all means, ask away. All right, great. No questions? Okay, cool. I mean, we've gone for an hour. Might as well end it here then. The next live will be a bit more focused, in that I'll be going into some more TA, but mostly into indicators I use and how I use them and how you can build strategies with different indicators.